This is the Unit 2 question number 9. So basically this is very similar to the question number 8 that I have already provided with you a video. The only difference in this case is we do have a non-controlling interest, because for these questions we have been told that we acquired 90%. We acquire 90%. With a 90% investment, we will have 10% non-controlling interest. So 10% non-controlling interest. The original day of the acquisitions, 1st of July 2002, and now we are required to prepare consolidated financial statements on 30th of June 2009. It is already many years after. Never mind, we know the day of acquisitions, so that's why we can separate the profit from the day of acquisition up to the beginning of the current year and also for the current year. How much we pay? We pay 500,000 to acquire this 90% subsidiary. On that day, all assets has been fairly valued. Therefore, there's no fair value adjustments required. No fair value adjustments. And the only capital and reserves that we have is share capital and retained earnings. Only share capitals and retained earnings are there. No other reserve, no fair value reserve, other reserve, etc. Therefore, the only equity figures is 450,000. So we know the book value of the equity. Therefore, we know the book value of the net asset. This is the information on the day of acquisition. Apart from that, we also have got the intra-group transactions. Intra-group transactions. We said that the opening inventory in P, include inventory acquired from S. We said that this is the inventory acquired from S, and therefore this is the acquisitions from subsidiary to parent, right? Obviously, this is from subsidiary to parent. How much we pay? On the transfer price, the transfer price is 52,500, while the original cost is 43,750. Therefore, the opening inventory itself contains some overstatement of the inventory. There's an overstatement of the inventory, and therefore we have to write it down. This is for open inventory, and everything has been sold. So therefore, all this unrealized profit at the beginning of the current year has been realized at the end of the year. This is the first transaction. And then during the year, the question continues to say, during the year. During the year, something happened. During the year, P made sales to S. Right? It's P could sell, right? It's P could sell. Therefore, this 81,250 is a purchase from parent to subsidiary. Right? It is parent to subsidiary. While there is also an intercompany transaction from subsidiary to parent. So that's why 65,000 is from subsidiary. 81,250 is from parent. We understand that if this is sales from the parent, we will not ask non-controlling interest to bear any adjustments. If this is a sales from the subsidiary, we will ask the non-controlling interest to share, and therefore the direction has an impact. Something further. The closing inventory in P include inventory acquired from S. So that means this is from S right? So the cost is 42,000, while the original cost was 35,000. Therefore, this means there is an overstatement of the inventory because the original cost should be 35, while you have sold it at 42. So this represents a 7,000 overstatement of the inventory. This is from S, right? This is from S. And finally, the closing inventory in S include inventory acquired from P at a cost of 15,000, while the original cost should be 12,000. So therefore, this represents a 3,000 overstatement of the inventory, and this is from P. This is from P, right? From P, we sell it to S. And therefore, for this 3,000, of course, we have to adjust, but we don't need to share it to NCI because this is sales from parent to subsidiary. Something further, goodwill has been impaired 3,750 in the current year and 20,000 in the past. This is the goodwill impairment. After the goodwill impairment, we also have a disposal of plant to subsidiary. Again, this is from parent, right? This is from parent. And therefore, for this disposal of plant, later we don't share it to NCI, but of course we have to adjust. And notice the day. The day is 1st of July 2008. Now it is 30th of June 2009. So that means this is actually the first day of the current year. The first day of the current year, we have got a gain on disposal, and this gain on disposal will be eliminated on consolidation. How much? We sell it for 145,000, while the original cost should be 101,250, and this plant have a remaining useful life of 6 years. In other words, this gain on disposal will be amortized over the remaining 6 years. Okay, so by reducing the depreciation adjustments. These are all the information, and therefore we can start to adjust. So as usual, we first provide the consolidation journal entry at the day of acquisitions. We have got the financial statement from the parent, and we have got the financial statement from the subsidiary. So from these financial statements, we can start to adjust. And we notice that the original cost was 500,000, and here the investment in subsidiary as stated in the parent's own book is also 500,000. So we will first credit it away. So we credit investment in subsidiary 500,000. This is exactly the amount that we have been told, right? 500,000, and therefore you see that we credit investment in subsidiary 500,000, which is the cost at the day of acquisition. But this 500,000 represents only our 90% investments. Our 90% investments. On top of which, actually there will be a 10% non-controlling interest, right? 10% non-controlling interest. So we see all the information from the question already, right? But we cannot find the fair value of the NCI, right? Obviously, this means we can only use the partial goodwill methods for the NCI. In other words, goodwill will be valued as a proportion of the fair value of the net asset. The question told us that share capital and retained earnings, 250,000 and 200,000 respectively. Therefore, we debit away the share capital at the day of acquisitions, and we debit away the retained earnings at the day of acquisition. Right? We adjust it. So we debit away the share capital and we debit away the retained earning at the day of acquisition. We know that actually this amounts to 450,000. 10% goes to NCI, right? 10% because NCI is valued as a proportion of the fair value of the net assets. So the proportion of the fair value of the net asset will be 45,000. So we pay 545,000, while the fair value of the net assets 450. So they cannot balance. So we got a balancing figure. So the balancing figure will be goodwill. Okay. So therefore, the goodwill is 95,000 as expected. Okay. So what we pay minus what we get is goodwill. Usually after this, we may provide for the additional depreciation due to the fair value adjustments, etc. But for this question, we don't have fair value adjustments, so therefore there's no additional depreciation for the fair value adjustments. So we can continue to account for the intra-group transaction. The first item that we have here is, we do know that we have an intra-group transaction during the current year. So subsidiaries sold 65,000 to parent. So this is an intra-group sales. Therefore, this intra-group sales must be eliminated. So we debit away the sales that the subsidiary has recorded as the sales, and we credit the cost of sales, or say we credit the purchase that the parent has recorded as a cost of sales. So anyway, we eliminate the consolidated sales and the cost of goods sold because of this intra-group transaction. The amount is 65,000, right? As mentioned here, 65,000. This is not sufficient because actually, because of this intra-group transaction, there has been an overstatement of the inventory. Here we said that the transfer price is 42,000, while the original cost is 35. So we must credit our inventory for the 7,000. And therefore here you see that we credit inventory to bring it back from 42 to 35. Whenever we credit inventory, we have to debit cost of goods sold. Therefore, we debit cost of goods sold. You can combine these two journal entries into one if you like, right? But here we show it as two journal entries. One, we eliminate the intra-group sales and purchase. Another one, we eliminate the overstatement of the inventory. Because of this, there will be a deferred tax implications, right? Because you credit the inventory, this credit is a consolidation adjustment. It affects only the accounting base, but not the tax base. And therefore, there will be a deferred tax asset, right? This is a deferred tax asset, 30% tax rate. And because you debit cost of goods sold, 30% tax rate, you credit income tax expense. Okay, so this is the current year intra-group sales from the subsidiary. We also have intra-group transaction from the parent. The question says that during the year, P Limited makes sales to subsidiary 81,250. 81,250. Therefore, we have to debit away this intra-group sales. Right, so we debit sales 81,250. We credit cost of goods sold 81,250. Right, this is to eliminate the intra-group sales and purchase between the parent and the subsidiary. Because of this, we also found that actually there has been an overstatement of the inventory, because the question says that the closing inventory in subsidiary include inventory purchased from parent at a cost of 15,000, while the original cost is 12,000. So this 3,000 must be eliminated on consolidation. Therefore, we credit inventory to bring it back from 15,000 to 12,000. Whenever you credit inventory, you have to debit cost of goods sold. And again, this is a consolidation adjustment. It affects only the accounting base but not the tax base. And therefore, what we have to do is we have to create a deferred tax asset, 30% tax rate. And because you debit cost of goods sold, you have to credit income tax expense, 30% tax rate. So this is for the current year intra-group transaction from parent to subsidiary. We also have an intra-group transaction from the parent, from the subsidiary to parent, which is an opening one. You can see that the question, the first sentence here, the opening inventories in P have got a acquisition of inventory from the subsidiary for 52,500, while the original cost is 43,750. So against the open inventory has been overstated. How much is the overstatement? The subtraction here shows that the difference will be 8,750. Right, 8,750. So last year you must have debited the cost of sales and credited inventory last year, right? This is what you must have done last year. You debit cost of sales, credit inventory 8,750 last year. This is what you have done last year. To repeat this journal entry, because you got a new financial statement from the parent and the new financial statement from the subsidiary, they did not put through this journal entry. So as a consolidation accountant, I will put through this journal entry. But this is last year's journal entry. Therefore, the cost of sales last year must have been posted to retained earning. Right? It must be retained earning. And if we simply repeat this journal entry, we have to credit the inventory. But the question says that all the open inventory has been sold already. So we debit away all this inventory and we credit cost of goods sold. So it will be posted to cost of goods sold. Right? So the adjustment is actually we should debit retained earnings and credit cost of goods sold. But one further adjustment is we have been told that this is actually a transaction from the subsidiary to parent, from subsidiary to parent. Therefore, not only retained earnings, but also we have to share it to NCI. Okay, so we have to share it to NCI as well. And therefore, the actual transaction is, because of this one, we have to debit retained earnings, we have to debit NCI, and we have to credit cost of goods sold. So therefore, here you see that we credit cost of goods sold, and we debit retained earnings, and we debit NCI. this is a 90% subsidiary, so therefore 90% goes to parent, 10% goes to NCI. 90% we debit retained earnings, 10% we debit NCI, and we credit cost of goods sold because all the relevant inventory is sold. So we don't credit the inventory because no longer we have got the overstatement of the inventory. Good. So we have to account for the deferred tax implications as well. Because you credit cost of goods sold, you debit tax expense, 30% tax rate. Because you debit retained earnings, you credit retained earnings here, 30% tax rate. Because you debit NCI, therefore you credit NCI here for the 30% tax rate. This is just the deferred tax implication. After that, we also have an intra-group transfer in relation to a plant. The question says that on 1st of July 2008, P sold an item of plant to subsidiary for 145,000, while the cost was 101,250. So that's why this is a gain on disposal, right? So if you subtract 145,000 with this 101,250, you find that there is a gain on disposal. The gain on disposal amounts to 43,750. So this intra-group transfer of the plants occurred in the current year, right? This is the first day of the current year, and therefore we debit gain on disposal for the current year. So this is the debit to the gain on disposal. We have to reinstate the original cost, and we have to reinstate the original accumulated depreciation. The question says that the original cost of this should be 168,750. 168,750 is the original cost. Therefore, we have to move it back from 145 to 168,750. And in addition, we have to reinstate also the accumulated depreciation, 67,500. Therefore, we credit accumulated depreciation to reinstate the accumulated depreciation to 67,500. And we also debit the plant to bring it from the new transfer price, 145,000, back to the original cost, which is 168,750. This is what we have to do at the day of intra-group transfer to bring it as if there's no intra-group transfer. We debit away the gain on disposal, we reinstate the original cost of the plant, and we reinstate the original accumulated depreciation. And because of this transaction, you debit gain on disposal. Therefore, you have to credit tax expense on a net basis. On a net basis, you have credited the value of your plant, and therefore, on a net basis, you have to create a deferred tax asset. On a net basis, your value, because of this consolidation adjustments, you credit the net book value of your consolidation amount, 43,750, 30% tax rate. This will be 13,125. This intra-group transfer occurred on the first day, Therefore, now at the end of the year, 1 year depreciation has been made. 1 year depreciation. Within that, this gain on disposal, this unrealized profit, must be realized throughout the remaining useful life, or say, because the transfer price is higher than the original net book value, the recipient of this plant must have over depreciated. Because it has been over depreciated, now we have to credit depreciation every year to bring it back to the original depreciation. How much will be over depreciated? It must be 43,750 divided by the remaining 6 years. The question says that the remaining life is 6 years. Right, 6 years. So the overstatement of the value divided by 6 years must be the depreciation that has been overstated. So now we have to move it back to the original. So we credit depreciation 7,292. Whenever you credit depreciation, you have to debit accumulated depreciation. This is the first year after the day of transfer, therefore only 1 year adjustments on the depreciation. Next year, it will become 2 years reversal of depreciation, etc., etc. And because of this, right, you have credited your depreciation expense, therefore 30% tax rate, you have to debit the income tax expense. Because you debit accumulated depreciation, therefore you have to reverse the original deferred tax assets at the time that you have created your consolidation adjustments. So you have got a deferred tax asset. So therefore 30% tax rate, you have to reverse the deferred tax asset, 30% tax rate. So this try to adjust for the intra-group transfer of the plant. After that, actually the question have got some other information. Say for example, we have been told that there has been an impairment. There has been an impairment. Goodwill has been impaired 3,750 in the current year and 20,000 in the past. Therefore, we have to credit goodwill for a total amount of 23,750. Therefore, here you see that we credit goodwill 23,750, out of which 3,750 is for current year and 20,000 is in the past. In the past, we will debit retained earnings. It is not the current year impairment. It is the impairment in the past. So past year's P&L item have been closer to retained earnings. So therefore, we debit retained earnings, we debit impairment loss, and we credit accumulated depreciation for the accumulated impairment for the goodwill, or you can credit directly the goodwill because this is an intangible asset. Right, because this is goodwill, we can credit directly the goodwill. Anyway, it will not be reinstated because this is goodwill, right? Goodwill are not to be reinstated anyway. The point that I have to emphasize here is you simply debit retained earnings. We don't need to share it between retained earnings and NCI because we are using partial goodwill method. NCI was initially recognized as a proportion of the fair value of the net asset. Therefore, there's no goodwill component for the NCI that you have recorded. At the very beginning, you did not record goodwill for NCI. Therefore, now the impairment of goodwill have nothing to do with NCI. Therefore, you simply debit retained earnings because this impairment is only the impairment for the goodwill for parent, right? No need to share with NCI. We don't record goodwill for NCI at all. The question also mentioned about the management fee, right? So there is an intercompany management fee. So we debit away the income and we credit away the expense. So we simply debit away the management fee income and we credit away the management fee expense. Something further, we start to share the profit of this subsidiary. So we want to share the profit of this subsidiary. The question says that, of course, we can find the profits for this subsidiary. We find also the opening retained earnings, but we notice that actually this subsidiary has paid out dividend. Whenever the subsidiary has paid out dividend in the current year, well, you notice that the profit is before the dividend, right? So therefore, when you share the profit, actually it contains the dividend component, right? So therefore, if we have got the current year dividends, you have to eliminate this intra-group transaction. The amount is 116,250. Dividend pay is a debit. Therefore, to eliminate means we have to credit. Therefore, here you see that we credit dividend pay by the subsidiary, out of which 90% must be received by the parent. So the parent must have got a dividend income. This dividend income recorded by the parent should be eliminated. So therefore, 90% we debit dividend income of parent that they have recorded. 10% we debit NCI. %, 10%. After that, we start to share the profit. As I've said before, we know that's the profit for the year 126,000, opening retained earnings 299. We start from the year one first. So we share the post-acquisition increase in retained earnings. At the day of acquisitions, the retained earning was 200,000. At the beginning of the current year, it increased to 299,000. Right? At the day of acquisition, it was 200,000. Now it increased to 299 at the beginning of the current year. Any increase in the retained earnings, 10% goes to NCI. 10% goes to NCI. Therefore, we debit retained earnings for the post-acquisition increase in retained earnings. Allocated to NCI will be 9,900. So therefore, we credit NCI 9,900, being 10% of the increase in retained earnings from the day of acquisitions up to the beginning of the current year. After we have got the current year, from the financial statements, we know that the profit for the current year is 126,000. But this is only the profit reported by the subsidiary. The subsidiary did not take into account our consolidation adjustments. We do have many consolidation adjustments affecting the current year profits, but not all will affect NCI, only if it is from the subsidiary, right? So therefore here, first one that we have is, we do have adjustments here, 7,000, which is from subsidiary with a related tax expense. This is the first adjustments that we have to make. Subsidiaries' own financial statements did not take into account this consolidation adjustments. Subsidiary in its own financial statement think that they have already sold. It is correct, right? But on consolidation, we say that this is within the group. We should not recognize this profit, and therefore we have to reduce it. And because this is the sales from the subsidiary, we will ask non-controlling interest to share these adjustments. For this journal, right, because this is the sales from the parent, we will not ask non-controlling interest to share. And then for this unrealized profits in opening inventory, this is from subsidiary again. For this one, you have credited the cost of goods sold with a related tax expense. So this is from subsidiary, and therefore we will ask non-controlling interest to share. So basically there will be two adjustments, this one and the previous current year adjustments. So therefore from the 126,000, we adjust first for the current year adjustments. We think that the inventory should not be overstated. So therefore we have adjusted the profit 7,000 with a related tax credit. And also for last year's, as mentioned here, we have debited the income tax expense with a credit to the cost of goods sold, so profit increase for this case. So therefore we add this profit with a related tax expense. Altogether, the adjusted profit after tax 127,225, 10% goes to NCI. Now you have prepared many journal entries. So what we have to do now is we have to put everything into our worksheet. Right, so you got all the adjustments. Right, and then you got your consolidated figures. Right, consolidated figures. So in the quiz, right, we will have many boxes like this, right? What you have to do is you have to fill in the figures correctly. Every figures will give you marks. Remember, as I've said in the hint, there will not be any comma, no need to have comma, no need to have space, no need to have positive, negative, etc. Just type the figures. Right? So if it is 11,625, just type 11625. Right? Just type the figures itself. No need to have brackets, no need to have anything, just the figure. So this is the consolidated income statement. And here we have got the consolidated statement of financial position as well. So what you have to do is just to put all the figures here, and then you got the correct answer. You notice that here we have got our figures for non-controlling interest, right? So after all the journal entry affecting the NCI, you have got the non-controlling interest, right? So probably this non-controlling interest you can calculate from here, but sometimes the question will ask for the analytical check. As I've said before, usually the analytical check consists of three components. The three components are the book value of the net asset, the fair value adjustments, and the goodwill. Right? This is the three components that we have. For this particular questions, at the day of acquisition, the fair value of the net asset is the same as the book value. Therefore, for this question, there's no fair value adjustments required. There's no fair value adjustments at the beginning, and therefore there's no fair value adjustments remains. And for these questions, we are using partial goodwill method. In other words, we did not record goodwill for NCI. Therefore, when we reconcile this, there's no goodwill for NCI at all. So therefore, for this question, actually, we need to account for only the book value of the net asset. Book value of the net asset. For this question, how much is the book value of the net asset? You can see from the financial statements of the subsidiary. The reported book value of the net asset, we can see here. So this is the equity. So the equity amounts to 558,750. Right, so this is the book value of the net asset. Of course, you can calculate the same using assets minus liability. It must be the same. Anyway, we start from this 558,750. Right, so this is the figures. 10% goes to NCI. Therefore, the book value of the net assets that the subsidiary reported is 55,875. However, as I've said before, the financial statement of this subsidiary did not take into account our consolidation adjustments. If there exists any unrealized profit selling from the subsidiary, we will ask the non-controlling interest to share. So therefore, the unrealized or the remaining portion, we have to adjust here. For this question, last year's transaction has been fully realized. Right? So therefore, there's no portion here that we have to adjust. But for the current year one, you do have 7,000 overstatement of the inventory with a related tax expense. Therefore, for this portion, it remains unrealized at the end of the year. So therefore, the net assets should be reduced. Right? The consolidation adjustment will reduce the net asset. How much? It must be 7,000 minus the tax relevant. So 7,000 minus 2,100 is 4,900. 10% should be shared by the NCI. So the amount 490 reduced it. So you successfully reconcile the NCI figure 55,385. Good.